All right, today we're going to peel back the curtain on a world that manages literally trillions of dollars of our collective savings, institutional real estate. And it all starts with what you might call the billion-dollar question.
So just imagine for a second. You're not buying a single house. You're buying a whole portfolio of skyscrapers, huge shopping centers, massive warehouses. How on earth do you keep track of all of that? I mean, how do you really know if you're making money? That's the core problem we're going to unpack today.
And the stakes? Well, they could not be higher. We're talking about absolutely staggering amounts of money. Just one major index that keeps tabs on the biggest funds in this space. It represents over $1.2 trillion in assets. Yeah, this is not monopoly money. This is the financial bedrock for millions of people's futures.
Now, we need to be clear. Managing these modern fortunes is nothing like flipping a house on TV. These are massive, illiquid assets. You can't just sell a skyscraper with a few taps on an app, right? And they're owned by these huge institutions that, well, manage all of our collective savings.
So when we say institutions, who are we actually talking about? Well, it's things like your pension fund, the one that's supposed to take care of you in retirement. It's a university's endowment that's funding scholarships. It's even the insurance companies that have to be ready to pay out claims. These are serious, sophisticated investors, and they have a huge responsibility to protect and grow that capital.
So, because the stakes are so incredibly high, you can't just rely on a handshake and a simple spreadsheet. The whole industry knew it needed a solution. It needed a standardized rulebook, a common language designed to create clarity, accountability, and, probably most important of all, trust.
And that system is what we call institutional reporting. The best way to think about it is as the ultimate communication system. It's all about making sure the people managing the money are giving crystal clear, honest answers to the people who actually invested it.
And look, this isn't some informal, casual agreement. This is a highly formalized system with very serious oversight. You've got government watchdogs like the SEC making sure everything's legal. You have investor groups like ILPA pushing hard for transparency. And you've got global standards known as GIPS that are basically the gold standard for reporting performance. All of this together gives the framework real teeth.
Okay, so we have this rulebook, but what does it actually demand in practice? Well, it really all boils down to answering two super fundamental questions for any investor out there. What exactly do we own, and how well did we actually do?
And right away, we hit this huge difference between theory and reality. You'll hear managers talk about gross IIR. That's kind of the theoretical pie-in-the-sky return of the property itself. But savvy investors, they couldn't care less. They only care about the net IIR. That's the real, actual profit that lands in their bank account after every single fee, every expense, and the manager's cut has been taken out. You can see why transparency here is everything.
But think about it. How do you value a totally one-of-a-kind skyscraper? It's not like you can just look up its stock price. As you can see here in this table, most big real estate assets fall into what's called level 3. All that means is that their value is based on complex models and, frankly, a lot of expert judgment, not a simple market price. And that is exactly why having a super rigorous, transparent appraisal process every single quarter is absolutely non-negotiable. Okay, so we know how assets are valued and we know how performance is measured. But when a building finally gets sold and there's a big chunk of profit, how does that cash actually get split up? This is where we have to understand a really critical concept called the distribution waterfall.
Now, it sounds complicated, but just think of it like a series of buckets filling up in a specific order. Step 1, the investors get all of their original money back. That comes first, period. Step 2, they get a pre-agreed minimum profit. This is often called the preferred return or a hurdle. It's like a minimum performance bar the manager absolutely has to clear. Only after those first two buckets are completely full does the manager even start to share in the big profits.
So that brings us to how the managers get paid. They earn a small, pretty consistent management fee just to keep the lights on and run the day-to-day. But their real payday, the big prize, known as carried interest, only kicks in after the investors have gotten their original money back plus that minimum profit we just talked about. The whole thing is structured to make sure the manager only wins big when the investors also win big.
So let's bring this all together. What does this all mean for investors in today's world? Well, their demands have evolved way beyond just seeing a simple return number. They want the complete picture, the whole story. First and foremost, they demand radical transparency. I mean, they want to see every single fee, every expense, and any potential conflict of interest laid out in plain sight. There's just no room for hidden costs or funny business anymore.
Second, they have to understand the risks. Are all the assets located in one city? Does one single tenant make up way too much of the portfolio's rent? And a huge one today, how secure is our data? Managers are expected to report on all of it.
And finally, impact. You see, it's no longer enough for a building just to be profitable. Investors are demanding to know its ESG. That's environmental, social, and governance performance. What's its carbon footprint? Is it actually prepared for future climate risk? And these are not just ethical questions. They're hard-nosed financial questions that directly impact a property's long-term value. It's a core part of the report now. You know, this quote from our source material really says it all. This isn't some niche, boring topic. This reporting framework is the very foundation. It's the system that allows the vast majority of professional real estate investing to even happen in the first place. It is the engine of the industry.
So, what's the key takeaway from all of this? Well, this super detailed reporting is so much more than just paperwork. It's really a sophisticated system of trust and accountability. It's what translates these complex physical things, like buildings, into a common financial language. And that's what enables trillions of dollars from our pensions and our university endowments to be invested with confidence.
And that leaves us with one final question to kind of chew on. As all of this reporting gets more and more detailed and data becomes perfectly accessible, what happens to the classic art of real estate investing? Does that gut instinct just disappear? Or does it simply evolve into a new, more sophisticated game? It's something to think about. Thanks for digging into this with me.